Are you thinking about buying a home or just curious about how mortgages work? You've come to the right place. In today's video, we're going to break down some of the most important terms you'll hear when talking about a mortgage. Don't worry, by the end, you'll have a much better understanding of what these words mean and why they matter. We'll cover things like APR, PMI, escrow, and more. So, let's jump right in. What is a mortgage? Before we dive into the terms, let's start with a quick reminder. A mortgage is simply a loan you get to buy a house. You pay it back over time, usually in monthly payments, with interest. Now, let's talk about some of the key words you'll hear when getting a mortgage. 1. APR, annual percentage rate. You've probably seen the term APR on credit card offers, but it's also important in the mortgage world. APR stands for annual percentage rate. This number tells you the overall cost of your mortgage each year, including the interest rate and some of the fees. For example, if you're comparing two loans, one might have a lower interest rate, but a higher APR because of extra fees. That's why the APR is important. It helps you see the big picture when it comes to what you'll actually be paying over time. 2. PMI, private mortgage insurance. PMI stands for private mortgage insurance. This is a special type of insurance that protects the lender, not you, if you can't make your payments. You might have to pay PMI if your down payment is less than 20% of the home's price. So, if you're buying a house and don't have a big down payment saved up, PMI could be added to your monthly mortgage payment. The good news is, once you've paid off enough of your loan, you can usually cancel PMI. 3. Escrow. Next up is escrow. Escrow is a special account where some of your money is held to pay for things like property taxes and homeowners insurance. When you make your monthly mortgage payment, part of that payment goes into the escrow account. Then, when your property taxes or insurance are due, the money is paid out of escrow. Escrow makes it easier for you because you don't have to worry about paying a big tax bill or insurance premium all at once. It's spread out over your monthly payments. 4. Principal and interest. Every month when you make your mortgage payment, it goes toward two things, the principal and the interest. The principal is the amount of money you borrow to buy the house. Interest is what the lender charges you for borrowing that money. At first, a larger part of your payment will go toward the interest, but as time goes on, more of it will go toward paying off the principal. This is called amortization. 5. Fixed rate versus adjustable rate mortgage. Another set of terms you'll hear is fixed rate mortgage and adjustable rate mortgage, ARM. With a fixed rate mortgage, your interest rate stays the same for the entire life of the loan. That means your monthly payment will always be the same, making it easier to budget. An adjustable rate mortgage, or ARM, has an interest rate that can change over time. For example, your rate might be fixed for the first few years and then adjust based on market conditions. This could mean your payments go up or down after the initial fixed period. 6. Down payment. The down payment is the amount of money you pay up front when buying a home. Most lenders require a down payment of at least 3% to 20% of the home's price. The larger your down payment, the less you'll need to borrow, which means lower monthly payments. Plus, if you put down at least 20%, you won't need to pay PMI. 7. Amortization. We mentioned this earlier, but let's dive a little deeper into amortization. This is the process of paying off your mortgage over time through regular payments. Each payment reduces the amount you owe, but in the beginning, most of your payment goes toward interest. Over time, more of your payment will go toward the principal, meaning you're building more equity in your home. 8. Closing costs. When you buy a home, you'll have some closing costs. These are the fees you pay to finalize the purchase. They can include things like appraisal fees, title insurance, and attorney fees. Closing costs typically range from 2% to 5% of the home's purchase price. Be sure to budget for these costs when planning to buy a home. Wrapping it up. So, there you have it, some of the most important mortgage terms you need to know. Understanding these terms can make the mortgage process a lot less confusing. Whether you're buying your first home or just want to understand how your loan works, knowing terms like APR, PMI, escrow, and more will help you make better decisions. If you have any questions or want to learn more about how these terms apply to your mortgage, feel free to reach out. We're here to help you through every step of the process. For more information or to get started, be sure to connect with us. We're always happy to help you understand your mortgage options and find the best fit for you. Thanks for watching.
Thank you so much for watching the video. We are here to answer all your questions you may have about the mortgage process, whether you're purchasing or refinancing. You can reach us at 615-400-6764. That's 615-400-6764 via call or text. And also you'll have my email address down below. That's mhelton at OneTrust. That's ONETRUST, home, HOME, loans with an S.com. mhelton at OneTrustHomeLoans.com. Thanks again and have a great day. Talk to you soon.